Hello again, viewers. I am Mark McFadden with Onyx Equities Group. Today, we'll be going over some key terms. I think it's very imperative that we understand these terms, understand their meaning and their makeup in the investment strategy that we are undertaking in private equity. The terms that we'll be going over with today will be IPO, venture capitalist, direct listing, SPAC, and private equity. The first term that we'll expand upon today is private equity. What is private equity? So roughly $3.9 trillion in assets were held privately as of 2019. Private equity is simply companies that are privately held. They are not traded on any public exchange, NYSE, NASDAQ, S&P 500. They are held by people that are venture capitalists, angel investors, institutions, insurance companies, but they are some of the most well-known companies that we have heard about and that we are very interested in trying to invest in. Historically, those of high net worth, accredited investors, institutions were the only folks that were able to get in to invest in these privately held companies, okay? Private equity is ownership or interest in an entity that is not publicly listed or traded, just that simple. So how do you and I get into a place where we have the opportunity to invest in these privately held companies if we're not accredited investors individually? If we're not high net worth individuals like sports athletes, entertainers in Hollywood, music, if we're not the large institutions like Berkshire Hathaway, Goldman Sachs, how do we get involved? This is what Onyx Equities Group, OEG, brings an opportunity for us to come together in a transparent, collaborative space. We have accredited investor status at a few firms on Wall Street, and we're pooling resources together from the average everyday person to invest in these same companies that we see and hear about all the time. So for our first term, private equity, the key takeaways are private equity refers to capital investments made into companies that are not publicly traded. Most PE firms are open to accredited investors or those who are deemed high net worth, and successful PE managers can earn millions of dollars a year. Leveraged buyouts and venture capital investments are two key PE investment subfields. Our next term we're going to go over is IPO, initial public offering. So what is IPO? IPO refers to the process of offering shares from a private corporation to the open public. This is a new stock issuance. Public shares are issued to allow companies to raise capital from public investors. The transition from a private to a public company can be an important time for a private investor to fully realize their gains. So when the company is privately held, you have investors that have invested into that company. It's important to note that when you invest into a privately held company, you have to be ready for your money to be tied up for a period of time. Until that privately held company becomes a mature company and a company that the members and board feel can do well on the public market, the early investors' money are tied up. It's also important to note that there are many rounds of raises of capital in private company. Initially, you have your angel investors, which are the very first people that invest in a private company. Those investors typically are family, early VC companies, or large type of companies that partner or maybe spin off a part of their company to start up this new company that is privately held. Then you have other series of raises, like a series A, B, C, and D, and so on and so forth, that a private company may undertake to raise funds privately to keep its operations going. Okay. Once it gets to a certain point, then they file for an IPO, the initial public offering, to take the company from private to public and issue new stock on the open market. Okay, so for IPO, the actual type of key takeaways are: an initial public offering refers to the process of offering shares of a private corporation to the public in a new stock issuance. These are new stocks. A company must meet requirements by exchanges in the Securities Exchange Commission, SEC, to hold an initial public offering. So you have to have filed and made your intent known that you wish to take your actual private company public. IPOs provide companies with an opportunity to obtain capital by offering shares through the primary markets. That's through exchanges that we all trade on: S&P 500, NASDAQ. Company normally hires an investment bank to market, to gauge demand, set the IPO price, and the date. So these companies are like Morgan Stanley, Burns and Stearns, Goldman Sachs. They are hired by the private company, and they make a commission, and they are the ones that set the actual type of demand, or, well, not actually set the demand, but they gauge the actual demand. They help set the IPO price and the date when that company comes out on the public exchange. An IPO can be seen as an exit strategy for a lot of the early investors. This is how they realize their investment. They might have held their money on the private or, like the secondary market for years. So when the company goes public, this is their chance to have those private shares converted and sold. The next term is direct listing or direct public offering. A direct public offering or direct listing is a type of offering in which a company offers its securities directly to the public to raise capital. An issuing company uses a DPO to eliminate the intermediaries, the investment bankers, or kind of like the broker dealers and underwriters that are normally a part of the IPO process. This is a way to go directly from private to public without having to pay, for instance, a Morgan Stanley a hefty fee in order for them to do the research, set the date, set the IPO price. Also, some companies go direct to the public if they have a good cash balance sheet, and they don't need the to raise additional capital, which is done through the IPO process. So with direct listing, key takeaways: with a direct public offering, a direct placement, a company raises capital by offering its securities directly to the public. DPO enables a company to eliminate the intermediaries, saving them much needed money. They are normally part of such an offering and ultimately cut costs. Raising money independently allows a firm to avoid the restrictions of the bank and like the venture capital funding. The terms of the offering are solely established by the issuing company. Pre-DPO, the company must present compliance documents to regulators of each state where it plans on offering securities. But unlike with an IPO, the firm doesn't usually need to register with the SEC. So there's still regulatory guidelines that they must follow, but they just don't have to normally file with the SEC. Another key point between IPO and direct listing is that the privately held shares by the early investors, when they, if the private company does a direct listing, there's no lockup period. Typically, if a company goes private to public in an IPO, there's a lockup period, normally 6 months, where the folks that got in early on the privately held side, they can't sell their shares until 6 months after the IPO. Direct listing takes that out of the equation. As soon as the direct listing hits the public markets, those folks can sell their shares. The next term that we have heard about a lot lately, especially in 2020, is SPAC. SPAC is Special Purpose Acquisition Company. A special purpose acquisition company is a company that's formed for the sole purpose of acquiring a privately held company to go public. Okay, a SPAC has no commercial operations. Again, it's formed strictly to raise capital with the intent purpose of acquiring an existing company, also known as blank check type of companies. Okay, SPACs have been around actually for a while. It came back in type of prominence in 2020 with over 50 SPACs formed to raise funds to acquire privately held companies. Okay, so with with SPAC, the key takeaways are it's a special purpose acquisition company formed to raise money through a initial public offering to buy another company. At the time of their IPO, SPACs have no existing business operations. Okay, investors in SPACs can range from well-known private equity funds to people in, kind of like the general public. SPACs typically have 2 years to complete the acquisition, or they must return their funds to their investors. That's a key point. I'm going to take a moment to share my screen again. These are some web links to sources that speak a little bit more about the key terms that we discussed on this OEG Minute. IPO, venture capitalist, direct listing, SPAC, private equity. Again, the main premise behind Onyx Equities Group is collaboration. A lot of times to get into these private equity deals, the minimum investment is normally $50,000 to $100,000. And you have to be an accredited investor. Onyx Equities Group provides that platform where we are accredited investors and we're pooling members' resources together so that not one person has to come up with the $100,000 themselves. We pool resources together to come up with that, thereby giving ordinary people like yourself and me an opportunity to get into these deals like Airbnb, Uber, Lyft, Pinterest, that we ordinarily would not be able to get into. Thank you for watching. This has been another OEG Minute.